Now, let's imagine that you're a fairly risk-averse investor. You don't like to take huge risks and roll the dice on large gambles with your money, but there is one stock that you think the price of this stock is going to fall, but maybe not by that much. A bear call spread is an option strategy where you could capitalize on small price declines in a stock's price without taking much risk. Now, to explain the bear call spread, let's dive into the basics of a call option and work our way up from there. A call option is a financial contract that gives the buyer the right, but not the obligation, to purchase an underlying asset at a predetermined price, which we'll call the strike price, on or before a specific date, which we'll call the expiration date. Now, what if instead of buying a contract, I actually sold this call option to someone else? Well, that would mean that I have sold away the right to someone else to buy something from me at a specific price. Now, let's look at how this profit profile might look for me at the end of the life of this option. Now, if we're bearish, we might sell this call option or short a call option with a strike price of $50, which means that whoever bought the call option from us will have the right to purchase the underlying stock from us for $50, no matter what the price of the stock actually is. Now, in order for them to buy that right or that option from us, they had to pay us an upfront premium of $5. Now, let's take a look at the table to the bottom left for all the potential profits or losses we could experience in this situation. Now, if the stock price is $0, then the person who bought the option from us would not exercise it because they would not buy something worth $0 for $50. So the value in that max stock price minus strike price or zero column is just going to be zero because the option goes unexercised. However, we still received our $5 of premium up front, and so in this situation, we have profited $5. The same goes when the stock price is $50. They won't exercise the option. We got our premium. We're still up $5. However, that's where it starts to change. So when the stock price is $53, they will exercise that option against us. They'll buy something that is worth $53 from us for only $50. That represents a $3 loss to us. However, we still received our $5 premium up front, and so our profit is still $2. However, at $55 is when this whole thing breaks even for us because they can buy something for $5 less than it's worth. So we lose $5 there. We did receive the $5 up front in the premium. Our profit is exactly zero. However, for every dollar after $55, their profit goes up $1 for every incremental price increase in the stock price by $1. So we actually have an unlimited potential to lose money should the stock price rise significantly. What is a bear call spread? This is an options trading strategy that involves simultaneously selling a call with a lower strike price and buying a call option with a higher strike price. These options need to have the same underlying asset and the same expiration date. So they are in many ways offsetting of one another. What type of investor would a bear call spread appeal to? This might appeal to an investor with a moderately bearish outlook. What does that mean? That means that, let's say there's this particular stock where you feel that the price is going to fall, but maybe it's not going to fall by that much from its current price. You might prefer a bear call spread. And also, a risk-averse investor that doesn't want to take on too much risk. With a bear call spread, you can protect yourself, which limits your risk, but it also limits your potential upside. The first step in executing this bear call spread is to sell a call or short a call with a lower strike price. In this example, we're going to continue with the example we used earlier in this video, the short call with the 50 strike price. We receive $5 for the risk that we're taking on, and the payoff profile that you're going to see here is exactly the same as the one we discussed a few minutes ago. The second step in executing our spread is going to involve purchasing or buying a call option with a higher strike price. In this example, this long call, we are going to assume that it has a strike price of $60 and we have to pay a premium of $3 to get this option. One thing you'll notice is that a call with a higher strike price should have a lower premium than a call with a lower strike price. Now, we can see our profit profile at all the various stock prices in the table to the bottom left in the column titled Long 60 Call Profit. From all of the stock prices from 0 to 60, we are not able to exercise this option. So for all of those prices, we are just out the initial $3 that we paid for the premium. Once we get to $61, that is when we can exercise this option, and we can exercise it for a value of 61 minus the strike price of 60, which is $1 gain. However, we did pay our $3 premium to enter into this option, so we're still down $2. Our break-even price is going to be $63, and then for every single dollar that the stock price increases beyond that, we will have a $1 gain or $1 profit on our long call option. And you can see this reflected in the orange line on the graph to the right, that we have infinite potential to profit from this long call as the stock price rises. Just as on the short call, we had an infinite potential to lose money as the stock price fell, as shown by the blue line. Our bear call spread profit is simply just the offsetting of the gains and losses on the short call combined with the gains and losses on the long call positions. We can see in the bottom left table, we've added a new column called bear call spread profit. And at every single stock price, we can see what the profit of this strategy would be by simply just combining the payoffs of the other two options. Now, for a stock price of 0, you can see that both of these expire out of the money. We gained our $5 premium from selling the short call. We lost the $3 premium from buying the long call. And then our total profit is just a $2 of the excess of the premium of the short call over the long call. And this remains the same all the way up to $50. You can also see this on the graph on the right, which shows that the green line is a flat $2 value all the way from 0 to 50 stock price. Now, where things get a little bit more interesting is when the stock price continues to rise beyond 50. Now, 52 is a good example because the $3 profit from the short call perfectly offsets with the $3 that we spent on the premium of the long call, and our bear call spread profit is exactly 0. So 52 is our break-even point. Now, if we go beyond that, we're going to lose more and more money. Once we hit $60, we are going to be down $8 because we've now lost $5 on our short call and we are still out our $3 premium on the long call. However, every single dollar that the stock price increases past $60, we would gain $1 on our long call, but we would also lose $1 on our short call. So those profits and losses perfectly offset. And that's why after $60, that green line is perfectly flat all the way up to an infinitely high stock value. Now, what I said earlier was that this bear call spread strategy, it will have lower risk than, let's say, if we just shorted a call. So, right, we have a bearish outlook on this stock. We think the stock price is probably going to fall. So we could have shorted a call. That would have done better if the stock price fell, right? Because we would be up our $5 premium. Whereas if we do the bear call spread, we're only up our $2, right? Because we had to pay for the premium of the long call. But this limits our downside because if all we had done was the short call, we had an infinite potential to lose money as illustrated by that blue line, whereas the green line caps our loss, right? So if I think the stock price is going to go down, but only by a little bit, but I want to have a little bit of insurance in case it drops by a lot, I would prefer the bear call spread. Check out RyanO'ConnellFinance.com for help you need with finance tutoring or financial modeling, and watch my other videos on options here and here.